Palantir's stock price has exploded from $5 per share to over $190 per share, turning early believers into millionaires. Now, analysts are calling in another AI defense stock as the next Palantir. Could this be the next opportunity to 20x your money? Let's go take a look. Everyone is absolutely buzzing. The next Palantir. You've seen the headlines. If you miss Palantir, buy this stock now. So why are people chasing the next Palantir? Well, simple. Palantir exploded. This thing went from $5.87 a share to over $190 a share. That's almost a 20x return in a very short period of time. And when people see that kind of run, they start thinking, man, what if I caught the next one? They have FOMO, fear of missing out. We have all been there. Palantir's rise wasn't magic. It had true drivers behind it. Massive government contracts, diversifying into corporate contracts, cutting-edge AI tools, and super strong partnerships. They weren't just talking about AI. They were using it to help military and intelligence agencies make faster and smarter decisions. And today, we're digging into the defense stock that's being called the next Palantir. Is it legit? Does the price versus value make sense? Remember, we as value buyers want to buy when price is below value. So let's break this down the everything money way, through principle-driven investing logic, not emotions and feelings. Let's get right into it. Let's be honest, everyone loves the idea of finding the next big thing, that one stock that's going to turn $1,000 into 20,000. And the media knows it. Analysts, YouTubers, even CNBC personalities like Tom Lee and Jim Cramer, they throw out names every single week that this is the next Tesla, this is the next Nvidia, this is the next Palantir. It's exciting, but it's completely emotional. And the question is it logical? The problem is that this hype machine can lead people to confuse potential with price. Just because a stock might be great doesn't mean the stock is a great buy, especially if the market's already priced in that absolutely perfect future or even more. So let's talk about BigBear.ai. The ticker symbol is BBAI. It's a smaller, lesser known company that analysts are watching very closely in the AI and defense space. Now, this is not a recommendation. I'm not here to tell you to buy or sell in any video, let alone this one. This is about understanding the story and seeing what the market is seeing, potential, the risk, and everything in between. But more importantly, we're here to analyze the numbers to see if it matches the story. BigBear.ai's core strength right now is its position in defense and government contracting, a lot like Palantir was. But despite being a relatively small company, it has landed some serious deals. We're talking about a $165 million contract with the U.S. Army, a $13 million agreement with the Department of Defense, and a 5-year deal with the NSA. Those are major multi-year relationships that give Big Bear a seat at the big table. And with an overall contract backlog of $380 million as of a few months ago, there's a lot of locked-in business that can turn into real revenue over the next few years, assuming the company is able to execute. And that part is what's important, because Big Bear's success hinges on execution. A company can sign all the contracts in the world, but if they can't deliver on them, it won't matter. Just like an athlete. We all go to high schools and we see all these great athletes. We see the great athletes in college. And when they go pro, they fizzle. Yes, a few live up to the hype. But imagine if we gave every high school and college athlete $20, $30, $40 million a year who shows the potential of being the next big thing. I went to Michigan. And when I went there, the number one basketball player in the entire country was from Ann Arbor, Lavelle Blanchard. Lavelle Blanchard was number one by far. He actually was in the same recruiting class as Jamal Crawford, who had a very, very long NBA career. Guys, have you heard of Lavelle Blanchard? And this is not to knock him. He was a great player, and he just didn't come out as strong. Versus Jamal Crawford, who went to the NBA 1 year through college, had a very long career. If we went and gave Lavelle Blanchard this huge contract, what would have happened? Same thing applies to stock. Now, there is upside here for BigBear.ai as a company, especially as AI defense market itself is expected to grow to $70 billion by the mid-2030s. That's a big wave, and Big Bear is positioning itself to ride it. But defense isn't the only place that Big Bear is pushing. In 2024, they acquired a company called Pangiam, a move that expanded their capabilities into biometrics and facial recognition, something that's very important these days as we go on. Their system, Veriscan, is already being used to streamline airport security in places like Nashville. That commercial use, along with new partnerships in Panama and the UAE, shows that Big Bear is trying to diversify away from pure government contracts and tap into high-growth markets like travel, digital identity, and logistics. That matters because being tied too heavily to U.S. federal spending comes with a lot of unpredictability. In fact, that's a big reason why Palantir has done even better, because they said, listen, we have too much government contracts. We've got to diversify into more corporate kind of contracts. That meant smaller contract sizes, but a more diverse revenue landscape, which is very important for a company that's trying to really increase their cash flow. And of course, like most companies, leadership is another key piece of the story. In 2025, Kevin McAleenan, the former acting Secretary of Homeland Security, stepped in as CEO. Analysts viewed this as a strong move. He brings in deep experience and relationships within the federal government. And as the co-founder of Pangiam, he's personally invested in the company's success. The market responded very well to his appointment, which signals some confidence that Big Bear's new direction may lead to stronger execution and a clearer strategy. Guys, I know nothing about this guy, literally zero. But I will say this, I like him more than Alex Karp. I just think Alex Karp is such a tool. Now, the stock itself is known for wild swings, big gains and sharp drops, often tied more to hype than fundamentals. And while the company has strong contracts, it relies heavily on a few big clients. Guys, this sounds eerily familiar to Palantir's early days. Competition is another big challenge. Big Bear is going up against big giants like Palantir, Booz Allen, and even Lockheed Martin in some areas. These are companies with a lot more resources, deeper client relationships, and bigger teams. Big Bear's pitch is that it's smaller, more agile, and more focused, but it's still a very steep hill to climb. So, where does that leave us? Analysts see a company with a compelling story and a real opportunity, especially in defense AI and commercial biometrics. The new leadership brings credibility. The backlog provides revenue visibility, and the international expansion could help stabilize the business over time. But at the same time, the risks are real. Execution missteps, financial instability, and tough competition could derail things very quickly. The real question is whether the fundamentals over time can justify the story. And this is where investors need to focus. Don't just chase that headline of the next Palantir. Yes, I realize that is our headline. We're asking the question though, is this the next Palantir? What has to happen for this to become the next Palantir? You need to understand the business. More importantly, you need to understand if the price is right. That's what we're here to figure out. So let's look at the fundamentals of the stock. Guys, look at this thing. It actually got up to $10.28 earlier this year, and now it's down to $7. $2.4 billion market cap. Now, a lot like Palantir, the free cash flow is a lot greater than the net income. Here's why this happens in software. When companies build software, they cannot expense that software until the software goes into use. So they're spending a lot of money, but then they're finally writing it off. So these write-offs are probably based on money they spent a long, long time ago. That's why the net income is showing up as a lot lower than the free cash flow. Now, their free 5-year average free cash flow loss is $31 million a year. Last year, they did $37 million. Their revenue of $150 million last year. Okay, guys, their price to sales ratio is 16. Why do I focus on this? Well, whenever you have companies that aren't making money, it's nice to be able to compare them to other companies in their industry that are doing well. A great way to do that is price to sales. Basically, you're dividing the market cap by the amount of revenue in the last 12 months. A company like Microsoft right now is 12 or 13. It probably should be 8 to 10. Now, you might sit there and say, oh my God, this is so much higher. Yes, but this has way more growth potential than Microsoft. Just to show you how crazy Palantir might be, what do you think Palantir's price to sales ratio is? It is currently at 137 for a company that's worth $470 billion. That is incredible at $184 a share. So I want you guys to remember something. I own stocks. For example, I had Sprouts Farmers Market. I bought it at 31 to 33. It went up to 165. And people are like, God, Paul, what a great buy. I'm like, guys, it's not worth 165. That's the difference between me and other people on YouTube. That other big promoter of Palantir on YouTube, he thinks that 184 means it's worth 184. I want you to remember, guys, that what we're here to teach is that you can love something and still realize it's overvalued. Palantir is likely very overvalued. Guys, at 15 times sales with a lot of growth potential, there could be a lot of potential here for BigBear.ai. This does not scare me at all. The question we have to ask ourselves is, when are they going to get to cash flow positive? We have to look at these things to understand that. Let's go look at their income statement to see how their financials have done. Now, one kind of worry for me, look at the last 4 years of revenue. They off to a great start, 50 million, 74, 146, 155, 155, 158, down to 152 in the last 12 months. I was not expecting to see this. Guys, you can't pay a premium for growth when the growth ain't there. Doesn't mean that there's not going to be growth in the future. But if the growth is so obvious, how did they start out with such a big bang and then for 4 years essentially be flat? That's concerning. I give a check mark to Palantir here. But guys, where's the growth here? In fact, there's a decline in revenue here. A decline. Okay, again, the future could be very bright. But this is where I go, hang on a second. We're hearing the stock is up a lot. We're seeing it's up a lot. Are the fundamentals really showing that? Remember, guys, in early startup businesses, there can be stagnation of revenue for a while before a big increase. So I don't want to dismiss that. But I was not expecting to see growth flat. I was not expecting to see that, especially for a company that's supposed to be this big growth play. Let's see if there's any analysts following this. Yeah, a few. And not much revenue growth there either. Guys, I don't know. This is weird to me. Now, guys, obviously we don't get all analysts here, but let's look at the 8 pillars. Now, the only growth here was revenue growth in the last 5 years, but guess what? You can even make this an X because it's pretty much flat. So guys, I want you to hear me out here. If you're new to investing or new to looking at a company and understanding the financials, let's look at it this way. If your neighbor came to you and said, hey, I want to sell you my mechanic shop. It's growing like crazy. It is awesome. And they say, oh, great, show me the financials. And then their financials were this. What would you say? Wait, what growth? Where's the growth happening here? Could be happening in the future. Now, they might come to you and say, well, yeah, but Paul, what you don't realize is I just got 5 contracts with the 5 largest dealerships where they're outsourcing all their mechanic work to me. Okay, different situation there. And there's a lot in the pipeline here. That $360 million in potential contracts that could happen, the question is over how long a period of time? How are they deploying things? How are they deploying their sales team? These are things to understand, especially early on with a company. And all along the way, guys, here's another concern I have. Dilution. What does that mean? Because I'm sure some of you who are new to watching this don't know what that means. Let's say a company has 10 shares outstanding and you own one of them. You own 10% of the business. Now, let's say they need to raise money to go grow. So they issue 5 more shares. So they take 10, make it 15. How many shares do you own now? Still 1. You went from owning 1 of 10 shares to 1 of 15 shares. You went from 10% ownership down to 6.66% ownership. That's dilution. You did nothing but stay committed to the company and they made your ownership less. Well, guys, Big Bear had 100 million shares outstanding. Now they have 320 million shares outstanding. 3 times more. You know what's crazy? Their revenue is up 3x. So essentially the people who bought day one, they've seen no gain in their ownership of that revenue. They went from owning having 105 million shares to split it with to 320 million shares while their revenue went up 3x. So when the shares increase by the same amount as the revenue, you've seen no gain from that. That's a huge red flag. Now, guys, even though the 8 pillars here don't look great, 8 pillars is a very important thing to look at to tell a story. It's not a buy decision or sell decision. I don't know if this is a buy or sell just based on the number of X's or check marks, but it's important to understand what the story is here. So if you want to have an easy shortcut to understand these 8 pillars, very simple. I got a link below. Click the link. I will email you a thorough PDF that'll explain each pillar to you, what it does, what it says, and why they're important. It'll be in your email, in your inbox within 1 to 2 minutes. Super easy. It's really important that we're all speaking the same language. So that's of interest to you. Click that link below. That way you have it readily available. So as you listen to more videos, you can easily access it. Now, one thing I'm going to say before we look at our stock analyzer. Most investors are going to lose money because they're trying so hard to pick massive winners. They're trying to pick the next Palantir. The best investors do the exact opposite. They eliminate the losers first. That's what we're doing when we're analyzing a stock. We want to sit there and say, okay, is the balance sheet okay? Is the future okay? Is the stock price so egregiously high that it can't even make sense at that point, and it would take just an insane performance by the company to even justify the price? That's how you think like a smart investor. You don't just follow the stock price. Now, the issue with a company like BigBear is it's so young. We don't know that future. They're talking about big growth potential, but yet we're not seeing it in the last few years. How is it taking them 4 years to just be flat? Where's the growth there? These are questions to ask. So let's make some assumptions over the next 10 years on BigBear. I'm going to warn you, though, it's going to be a very wide range of prices. And on top of that, I just talked about dilution. I don't know what they're going to dilute to. If they dilute even further, this is not going to factor that in there. So we're looking at this, and I'm going to be sitting there saying, where is the price? It's going to be hard to determine. So let's see what happens. Revenue growth, guys. Again, they've had like zero revenue growth in the last 5 years. Well, 5.47 a year. Let's do 10, 20, and 30%. Just an absurd number. 30% growth, 20, these are very high numbers. Profit margin. Let's go compare it to Palantir. Because if you look at their gross margin, it's only 28%. This means Palantir's gross margin is like 80 or 90%. That means every dollar they bring in revenue at Palantir, 80 or 90 cents of it goes to the bottom line. So what's the profit margin going to be here? I imagine it'll get better over time. Let's do 10, 20, and 30% as well. Same with free cash flow. PE. Big growth company, but in 10 years, what will it be? I'll go 15, 20, 25. And guys, again, we're just guessing here. And finally, a 9% return. As you can tell, this is a lot harder to do for a company like this than Microsoft or Google, where we know that the growth is going to be pretty consistent. There's a reasonable range of outcomes. Guys, the difference between 10% growth a year for 10 years and 30% is insane. How insane? Let me show you. At 10% growth a year, you're at 2.6 times revenue. At 30% growth a year, you're at 13.8 times revenue. Huge difference. That's what's very, very important to understand. So these numbers below are 9% return to get my intrinsic value. What's the value for it? But guys, you got to know, this thing needs margin of safety because you have to worry about the dilution that's on its path. You got to worry about all these things going on. So we hit the analyze button. Guys, I have a low price of $1, high price of 24, middle price of 6. And keep in mind, this assumes no dilution along the way. That's assuming they stop diluting. It's not as bad as I thought it was going to be. But guys, the question is, can this company do 20% growth a year for the next 10 years to even justify this? Or 30% growth to justify this? Is the juice worth the squeeze? That's the question you have to ask yourself. We all want to be able to spot and get in on the next breakout stock at a wonderful price. But the most important part is understand what is a wonderful price. Because just chasing a story and chasing hype, it's not going to work out very well for you. And I'm going to level with you. It's super important to get this knowledge and skill now before the market turns. So in this next video, we're going to show you how we think and value stocks like Warren Buffett and other great value investors so that you're prepared to act and be calm when others are panicking and selling. The video is linked right on your screen, so don't miss it. This is how you get ready for your moment. Thank you for your time.